Hi Zan, I'm Hewison. I'm coming to you as always from the digital studios of MarketClub. And today we're going to be talking about divergences. And these are elements in the market that are very important and you really should be aware of them. We're going to be looking at the first market. We'll be looking at today's gold, and we're looking at the S&P 500 and finally the euro. But let's take a look at gold. This is a spot chart of gold, and it's also a weekly chart. That's the nice thing about divergences. You can spot them on the weekly basis. Now, what a divergence is when a market makes a new high or a new low, does the momentum follow through? And what we're looking at here is a good example. This is an RSI indicator, and it stands for Relative Strength Indicator. And you can see how the price pattern, this is back in July of August of 08, and you can see how the prices were going down, lower prices, but you can see how the momentum of the RSI was actually going up. So the first low was right here, the next one was here, and then this final was here. So it's higher, but it's converging. It's a divergence of momentum. And from that you had a nice rally up. Now the same holds true, and I'm going to do this up to date for highs. So here we have an important high, here we have a new high, and finally another new high. But look, we're seeing a divergence here. This is actually going down where the prices are going up. So something has to give. And my bet is we're probably going to see some more sideways action and some sort of corrective action in the gold market. Not to say I'm not bearish on gold, but I'm just saying that is what the momentum indicates, the RSI is indicating. So what you're looking for always is for a divergence. And so new highs, but the momentum is going this way, and new lows, and the momentum's going that way. So that's what you're looking for. You're looking for a reverse action in the momentum indicators. You can use the RSI, you can also use the MACD, but for purposes here, we're just going to use the RSI. Let's take a look at our next market, and that's going to be the S&P 500. So let's take everything off the screen. Okay, we're back and we're looking at the S&P 500 INX on MarketClub, and this is again a weekly chart, so weekly candlestick chart, and this is going back to the October period right here, and this is October 2007. That's where the higher market made its high. But what I want you to look at is not so much these prices, but these prices here. This is the high. If you just dot that up, goes to here, and this is the all-time high, or the recent high is right here, and you can see you've got that divergence going. It's better if you actually examine this further out. That obviously was a precursor of this very sharp down move. Now what happened here, look at the prices and look at the divergence. That was a new low, but the momentum did not go down as far as this low. So again, these are all kind of points where a market's in a downtrend, but it's getting less and less push on the downside. And then of course you can see we had a very nice rally. What's interesting here is if we put in our monthly trade triangles, they come in right around these levels. So they caught this move very well on the upside. But again, looking for divergences. This is the RSI indicator, and we're looking at a weekly chart. You can do this on daily charts. We want to show you the weekly charts. For now, we'll show you maybe some daily examples if we have time. But again, it's a very important thing to follow. And let's just take everything off the screen, and let's go to a daily chart, and let's scope this in just a bit. So we only need, let's say, the year to date. Well, here's another good example. We're looking at this is a daily chart. So looking at the S&P 500. And as you can see here, look at the highs. This is all highs here. But you see from here on, this point on, the market's going like this. This is not a good sign. And of course, then you have the very steep, precipitous drop that occurred very quickly. And here again, you have a situation where you are seeing somewhat of a divergence. It's a little more difficult because of the tails here, but that's certainly something that you can look at. If you looked at this on a close only chart, that would be a lower close right here, and that would give you the divergence that we look at right here. So you can look at these on a daily and weekly basis. So let's look at our next market, which is going to be the euro. So let's take everything off the screen. Okay, we're back and we're looking at the euro versus the US dollar. This is August right here of 2009, and it's a daily chart. So you can see prices are going up here like this. New high, new high, new high. And look what was happening to the momentum. New low, new low, new low. And of course that was the precursor of this move down. Now it's not to say you can't get moves back up or rallies back up like we're seeing here, but it also indicates that this was in fact the top. Now here, as we're bringing this right up to date, you can see new low, definitely a divergence there. And look at how where the momentum basically caused this market to rally. And we're sort of in a holding pattern now, and I expect we rallied very sharply, got up to a high level, and we're sort of moving down. But I think we're going to see more sideways action and then a resumption of this downtrend, because the trend is very well established. But again, you want to use the RSI and the MACD, which both work very well. The RSI stands for Relative Strength Index, and it's usually a good way to find out the internal strength of a market. Again, divergences here and divergences here. You can use this on the weekly and daily charts. Works very, very well, but I think it's just another tool for you to put in your toolbox, your trading toolbox. Hey, this is Adam Hewison. Thanks for taking the time to watch and learn about the divergences in the marketplace. They're important and you should know about them. Every success.